Good morning, everyone. Welcome to the macro snapshot. We are Friday, May the 2nd, 2025, recording this, 7:20 in the morning. So I want to concentrate today, guys, on the non-farm payrolls, which is kind of obviously quite important data just to see what's going on. So first of all, let's just have a look and look at a couple of things here. So, I mean, the first big question is this going to be too early for sort of the real effect of tariffs to have made themselves known? And quite possibly, yes, because the data which we're going to be getting this morning, of course, is for the April period. And we know that we know that Trump only announced the tariffs on April the 2nd. So really, it's probably too early yet to have the full effects. So therefore, I think it's asymmetrical today in the sense that if we get a sort of a strong or solid number, I think the market will say, well, hey, we still don't, it really doesn't tell us anything important about the tariff effects. On the other hand, if we get a sign of weakness, I think there'll be asymmetry in the sense that the market will react very negatively and take a weak number as being early evidence of a slowdown in the labor market and therefore the broader economy. But because what we've been seeing so far is, weak levels of hiring. So we haven't seen many sort of, a lot of jobs being created or people being hired, but we're not seeing too much firing either, if you know what I mean. So the market, in order to become very, very bearish, it really needs to see a lot more evidence of firing. So we're sort of in an equilibrium point. And if we start looking at some of the sort of the data, let's just do a quick review here of some of the recent labor market data. What we can see is that the job openings was less than expected and less than last time. So, and last time was revised down. So you can say that the job openings were definitely, a little negative, a little softer. You could also see that the quits level, though, had actually gone up. So again, this whole idea is a little bit contradictory because the amount of people quitting voluntarily was actually stable or even went up a little bit, which ordinarily would indicate sort of a robust job market. So those numbers there don't really tell us a huge amount. Then if you look at the layoffs level, actually not particularly getting worse. Okay, so if you look, last time we had 1.79 million, this time 1.55 million. So again, it's not really like there's maybe a tiny bit of softening in the sort of employment, the active employment, but people are not being laid off or fired that much. So that's sort of indicating sort of stability there. Then if we look at some other indicators of the labor market, we did have an ADP that was down to 62,000 from 155,000, much lower than consensus. Again, that number is not very, highly correlated or perfectly correlated with the non-farm payrolls, but that number does indicate in the private payrolls, which I'll get to in a second, a little bit of weakness. If we look then at the initial jobless claims, you can see that was at 241,000. So, that is definitely higher than last time, which was 222. So you could argue that that's a bit of a problem. But I did a quick bit of research, and some of that stuff was quite technical. There were a lot of job losses in the state of New York. There were some specific industry things happening there. So it's difficult to know. And as I think I showed you yesterday, if we look at, let's say, something like the 4-week moving average in terms of the initial jobless claims, you can see here, if anything, over the last sort of period that's gone down a little bit. But if we just zoom out, you can see that it's basically pretty stable. And again, if we zoom out to, I don't know, we'll take it back to 2021, just after the COVID period. You can see that essentially we're somewhere between, 205,000 and 230,000. And by any historic measure, that is a very, very, very solid jobs market. So my point being, without belaboring it, that, the initial jobless claims are not signaling anything. Yesterday, yes, we had an extra 20,000, but you really have to smooth that out. That's quite a choppy number, and that's pretty solid. And then if you look at the ISM manufacturing, if you look at the employment situation there, that was actually better than expected and better than last time. So last time we had 44.7, expected 44.6, we had 46.5. So it's still not trending perfectly in the right direction, but it is actually better than expected, as were sort of a lot of those numbers yesterday from ISM at 10 o'clock, which really got the market's attention. So in terms of what we can expect today, I think let's just look at the numbers. So we're expecting 138,000 as the headline. As you can see, that's about 90,000 less than last time. If we actually look at the dispersion, let's have a look at the dispersion of estimates, and you can see that we have a low estimate of 50 all the way up to 175. So, dispersion here of, 120,000, which is quite a lot. we've got a standard deviation of, let's call it 25,000. So again, with a median of, let's call it 140, or I don't know, 131 for the average, the median's 138. We can say that anything two standard deviations would be what's that, about 80,000 or so, 85,000. And on the hot side, that would be two standard deviations would be something like about 180, 190,000. So that's something to keep in mind in terms of what would really get the market's attention here. So what personally I think we really should be looking at here as well is, which something I don't often emphasize, is the change in private payrolls as opposed to the government payrolls. Because the point is that the government stuff, we know that potentially there's been some sort of firings because of the Department of Government Efficiency, DOGE, and everything like that. I think really what the market wants to know, not so much about the sort of the government payrolls, is the private payrolls. As you can see here, we're expecting 125,000. Again, just to see, I'm not sure they give an estimate for that. Let's have a look. Oh, well done, Bloomberg. So again, the estimate here, pretty similar to the headline number. Estimate of 125 is consensus. Again, standard deviation of 25. But as you can see here, the low estimate, 60 up to 170. So, kind of a couple of standard deviations there for the estimates. But I think really, if this comes in lower than, let's say, 100,000, 80,000, something like that, that will get the market's attention, because I think really what the market wants to know is, is there structural evidence, or is there real evidence that in the private sector, not so much the government sector, which is very much tied up to politics and Trump and Elon Musk and everything like that, but in the private sector, are we getting, some kind of tariff-related slowdown? So let's look at this number here. As I say, anything, one standard deviation is 25,000, 25,000. So anything, let's say, I don't know, let's say a couple of standard deviations, I think definitely anything under 50,000 will get a serious reaction, but even under 75,000, I think would get the market's reaction. And you can see here before, last time we had 209,000. As always, we need to be looking at I mean, it's kind of interesting here. Bloomberg's added the 3-month average change. So that's something to be looking at there, just to see whether that's coming down. The net revisions we need to see. Also, the unemployment rate, is that going to tick up? It could be rounded up to 4.3. I was just reading some technical, kind of a preview this morning. There's, if it could, easily get up to 4.25, which would become 4.3. So that would be something to be looking at. And then the other thing, of course, as well, is the average hourly earning, the 0.3. This is important as always, just because of what's going on with the Fed in terms of the Fed pricing. And what was kind of interesting yesterday, let's just look at the Fed pricing. Just on the back, just to remind everyone, we got the ISM manufacturing yesterday at 10 o'clock, and we had a pretty dramatic sort of repricing of the front of the curve. So this is the December pricing. So this is for the SOFR futures for December of 2025. So the end of this year, what's priced in. And what you can see is that before we had the ISM manufacturing yesterday, the market was pricing in over 4 cuts. So about, where are we? About 107 basis points, which is 4 cuts. So the market had started to price in, if we go back, a relatively, well, a Fed, I don't want to say super dovish, but a Fed which was, potentially would have to be cutting on the basis of a slowing economy. But look at this very, very sharp repricing at the front end. We got about 10 or 15 basis points. We went from about 105 down to about 90. So it's about 14 or 15 basis points. And you look here, that was on the back of the ISM manufacturing yesterday. And as I say, those numbers were still in contraction territory, which is to say less than 50. But all of the numbers, so prices paid, new orders, employment, and the headline number were all actually better than expected. And so the market, it's almost like the market was saying, whoa, we need to sort of calm down a little bit. And now we have about, I think it's about 3.5 cuts. Yeah, so 3.6 cuts as opposed to 4 cuts are priced in for the December period. Also, possibly what was happening yesterday is that Treasury Secretary Bessent said that the fact that the 2-year yield was below the Fed funds rate was indicating to him, at least, that the Fed needed to be cutting interest rates. So I think for him, it was maybe a bit more of a sort of a political comment. But the market doesn't like to be told what to do by politicians. And so I just wonder if this repricing there was something sort of Machiavellian or sort of devilish from the sort of the stir market, basically saying to the Treasury Secretary, "Oh, you think those those rates are too low? Well, we'll push them up for you a little bit." So kind of interesting there, just that reaction there. Now, in terms of the market reaction today, as I say, I think it's a little bit asymmetric in the sense that if it's an inline number, the market might take that as a sort of a sort of a positive, a bit sort of hawkishly. We might get a bit of a sort of flattening of the curve there, front end led flattening. So we might see those front end yields going up a little bit, especially if we get a hot number. So a hot number, just going back to it, if we get a hot number, let's say, as I say, one or two standard deviations above. So, let's say 150, 170, 180, something like that. Definitely that's going to put more pressure on the front end of the curve. And that pricing we just looked at might even go down to 3.5 cuts or even down to 3 cuts at the front end of the curve. So we'll see the front end of the curve, those yields going up. So that's going to cause a front end led kind of steepening. On the other hand, if we get a soft number, I think that would be, and again, a soft number is like, let's say, anything from, let's say, I would say 40 or 50, 60,000 less than expectation. So you're talking something, sub 100, certainly sub 50 would definitely get the market's attention. Again, that would conversely be very positive for the front end, but I'd say even more than the 2 year, something like the 5 year, which would essentially have this logic that the Fed would need to be cutting more aggressively at some point. And the idea here being that inflation would be going down. And I just want to draw your attention, if we look at the SOFR curve here. So this is now is the white line. And 1 week ago is this kind of orange line here. And you can see that, just in the base of the last couple of days, the curve has repriced a little more hawkishly. So you see the implied yield has gone up a little bit. But I just want to draw your attention to the fact that there hasn't been a huge amount of repricing, in the very short term. So let's say for the May, June, sort of July contracts. And really a lot of that repricing is out into, it's kind of like, 6, 9 months away into the spring and summer of 2026. And I think what the market is trying to tell us here is that, inflation is still an issue. Inflation is still a little bit sort of sticky. And so the Fed, it's going to be very difficult for the Fed to cut quickly and soon and aggressively, because it still has to deal with this sticky inflation. And so what I'm trying to say here is that I think that even if the numbers are a little bit weak, we may see more sort of that sort of repricing back dovishly, so maybe sort of back down again. But again, I think we might see that more towards like December 25. March 26, June 26 in this area here, because I think the market is still it's not completely convinced that the Fed is able to, with impunity or with ease or in a relaxed way, to sort of cut very aggressively. Let's say, for example, next week we have the May meeting. That's still not priced at all. So definitely be looking at, that's what I'm trying to say. I think something like the 5 year might be more appropriate in the futures rather than, let's say, the ZT or the 2 year. Just in terms of the equities, let's actually just look at a couple of charts here. Now, we saw overnight there was a bit of a headline which caused equities to pop by it caused equities to pop by about 1% or so. And if we look here, we'll actually look at the ES futures, you can see that they actually popped, but they did hit some overhead resistance here at the 100-day, actually the 200-day moving average here, which is pretty important. And what was that headline? That headline was something essentially saying it was backed up by Rubio, the American sort of member of Trump's candidate, Marco Rubio. Sorry, it's early. But basically, earlier we had a headline from the Chinese saying that they were looking at potentially ways of, considering blah, 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 potentially opening negotiations with the US on a trade as long as they were respectful, et cetera, et cetera. So kind of quite equivocal sort of commentary, but nonetheless, one could argue that it was at least a small glimmer of sort of opening from the Chinese, saying that they were thinking about analyzing the possibility of opening sort of negotiations on trade. And the equity market definitely liked that. You can see it here on a daily. It popped quite a lot, but as I say, hitting the 200-day moving average. And when you actually start looking at the details there, you say, well, okay, well, what does that actually mean? They are thinking about analyzing the possibility of opening negotiations. Not exactly great. So again, you see the market gave it back. And if we put that on a 3-minute chart, just to really put this into perspective here, you see that there's the initial pop. So we had the Amazon and the Apple earnings, which were pretty solid, by the way, after the market yesterday. But there was some little concerns. Apple had a bit of a slowdown in sales in China, some concerns about forward guidance. But so we saw that the equity market actually came off after the bell yesterday. And here's your headline at about 8 o'clock, and you can see that that popped. But as soon as we get sort of crossover from the sort of Asian into the European session, you can see here that they at this pretty important 56 sort of 80 level on the futures, they started coming down again. So in terms of what could happen today, what is my personal view? Let's look at the SPX. Is just because that's sort of a bit cleaner sometimes without all the futures and everything. I think that the 5670 level, which is basically here 5671, 5670, this level here is absolutely key, because as you can see, it's just this sort of confluence here of the 100 and 200-day moving average. It's also at the top. This is the tariff gap. You see this sort of lilac box here. So you see, this is really the point at which you have to get through some moving averages. You have to get through some Fibonacci, sort of levels. And you essentially also have to basically say that, yes, the stock market should be in a higher position than it was before the announcement of the tariff. So I think this is an absolutely key level here. If this pops on a sort of an ordinary number, I think that would be an interesting point to start thinking about sort of long put spreads, starting to look at that, maybe with a 6 or 8 week kind of expiry, looking at sort of some lower strikes down here. And again, in terms of what could happen on a sort of a weak number, could the market test down to, let's say, something like 54.90 or something, which would be, something down around about sort of here, something around about here, to close that gap from the Trump tariffs. I think that would be quite an interesting sort of a target down there, which is about 54.90. So if we look on the ES, we can see the equivalent let me just try and, sorry, there's something on my screen here. So if we just look down there, you can see that if we do get a weak number, I think it's possible, as I say, just to fill this gap here. Hold on, what's going on here? Just give me a second. Yeah, just to go down here. So that's about 129 points. So that's quite a substantial move, over 2% here, which is quite a lot. And actually, the volatility, as you guys know, you can see here, the volatility has come down. It's trying to fill that gap here between the Trump announcement. So volatility has come down substantially. It's still not in the basement. It's not like 15 or 16. It's about 23, 24, but it has come down quite a lot. And that's interesting, because if we look at what the market is pricing, so let's look at some zero DTEs on the ES futures. So first of all, I want to bring your attention here. You see here for the June contract, ES. So still in the percentiles, we're still in the 90th percentile, so elevated volatility. But just in terms of the actual ranking, number 33 percentile here. So if you look at the 52 ranking, it's definitely come down. At one point, this was like at 98 or 99, a few weeks ago. So volatility is still elevated, but it's not at crazy levels. And if you actually look here, just what the market's signaling here, if we look at sort of at the money, just for a zero DTA, you can see that at the money implied vol's about 49 today, and you can see you'd be paying something like about let's say for about 34 for a call and about 35 for the put. So it's about 35 points. That's what the market is thinking, just for one standard deviation there. So that's not bad, actually. I think, they possibly even could be or should be a little bit more expensive. So that's not too bad. Just in terms of some other markets, guys, I don't want to dwell too much because I've already spoken too long. As I say, it's just an interesting side comment. We did get a comment from the Japanese Minister of Finance, I believe it was, Kato, who essentially in an interview with the Japanese press said that, of course, Japan owned a lot of US treasuries, and that was, of course, potentially a card in the negotiations. So, which was unusual, because that's quite blunt diplomatic language to sort of potentially be threatening the US about offloading all of their huge trillions of dollars worth of treasuries. So that was quite an interesting comment there, which I don't think the Trump administration would have appreciated at all. But just other things, just quickly looking at here, you can see that oil did puke down yesterday, as we thought. It tested these lows, but there were some headlines about the Americans putting an extra level of sanctions on Iranian oil, so that got a little bit of a market bounce. But still, this market does remain fairly weak. And if you actually look at the curve, kind of interesting. Maybe actually we would have a quick look at that. The curve's in quite an interesting sort of shape. for an oil curve. So let's just quickly bring it up. If you guys will bear with me for another few seconds here. And what I just want to show what the oil market is signaling, at least if you look at the curve, is yeah. So what you can see here, it's quite an unusual curve, is that it's in a backwardated state. And then we'll just zoom in a little bit. So you can see that essentially what it's still in a backwardated state. So this is quite interesting. It's saying that demand in the physical market right now is still relatively robust. Now we know that the spot prices have come down, the actual outright prices have come down. But if you look at the shape of the curve, it's still backwardated. So we're still having this backwardated kind of state. But what we can see is that later in the year, you know, the prices are a lot lower here. So it's almost like it's sort of signaling, it's quite, and then there's a big pickup. So it's almost as though it's signaling, it's like quite a steep sort of drop off here and then quite a steep sort of forward rise in the curve. Normally, I mean, the backwardation is, you know, in a strong market is not unusual. But what is unusual is this very sharp sort of pickup in the curve. Normally, this would be sort of a flatter thing, something like this. And so this seems to be sort of signaling that there's going to be some, I don't know, medium-term pain in the global, in terms of global demand for oils. You see here, but eventually things will get sorted out and oil demand will come back. So quite an interesting shape of the curve here, signaling that, you know, sort of the pain will happen in 3, 4, 5, 6 months and then might stabilize within a year or 18 months or so. So just keep an eye on that curve there. Okay, guys, I'm going to leave it there because I want to get prepared. The other thing as well, we did have a little bit of a dollar sort of comeback, so that's putting a bit of downward pressure on some of the precious metals and whatnot. So just have a quick look there, just at the dollar, which we'll put on the dollar index here. So again, you see that it did claw its way back up to the 100 level. Again, long-term prognosis, one could argue, is a little bit weaker, but a lot of people are short, and especially if you look at something like the Japanese yen, positioning is very, very, very short here. But we are getting to points here where we're starting to get some of these Fibonacci retracements. So if you look at the shorter term one at 145.3, that's reached that level there. And we're getting up to some of those interesting levels there, which, depending on what happens with the non-farm payrolls, could either give it a further push up in the US dollar, or if it's a weak number, could, of course, push it down a little bit. We shall see what happens. Okay, going to leave it there, guys. Good luck trading, and of course, have a wonderful weekend. Thank you.